You know what's interesting? For the past 18 months, gold stackers have been sitting on their hands, watching, waiting. While everyone else chased AI stocks and crypto pumps, they've been patient, accumulating quietly. And now, something just shifted. The signal they've been waiting for finally flashed green. And if you understand what I'm about to show you, you'll see why the next 6 months could redefine wealth preservation for an entire generation. Let me take you back to March 2023. Gold was trading around $1,900 an ounce. The Fed was raising rates aggressively. Everyone said gold was dead money. Why hold gold when you can get 5% in a money market, they asked. But here's what the smart money knew that retail investors didn't. Every single time in history when the Fed has raised rates this aggressively, they've eventually had to reverse course violently. And when that reversal comes, gold doesn't just rise, it explodes. Fast forward to today. Gold just broke through $2,700 and held it. But that's not the signal I'm talking about. The real signal came from somewhere most people aren't watching. The COMEX warehouse data. See, there's this thing that happens in the gold market that's invisible to 99% of investors. It's called registered versus eligible gold. Registered gold is available for delivery. Eligible gold is just sitting there, not available. And right now, registered gold at the COMEX has dropped to levels we haven't seen since 2016. We're talking about 8.2 million ounces of registered gold backing 58 million ounces of paper gold contracts. That's a ratio of 7 to 1. 7 claims on every physical ounce. Now, why does this matter? Because when that ratio gets stretched, when there are too many paper claims chasing too little physical metal, something breaks. And we're watching it break in real time. 3 weeks ago, a major bullion bank, and I won't name them, but their initials are JP Morgan, moved 2.1 million ounces from registered to eligible. They basically said, this gold is no longer available for delivery. That's not a small move. That's a statement. That's them saying, we see what's coming, and we're protecting our physical position. But here's where it gets really interesting. While COMEX inventories are draining, look at what's happening in Shanghai. The Shanghai Gold Exchange, which is the world's largest physical gold exchange, is showing premiums over London spot prices that we haven't seen since the pandemic panic of 2020. Right now, gold in Shanghai is trading at a $40 premium to London. $40. That means Chinese buyers are so desperate for physical gold that they're willing to pay $40 more per ounce just to get their hands on it. That's not normal market behavior, that's shortage behavior. And it's not just China. Look at India. Diwali just passed, traditionally the biggest gold buying season in India. Imports hit 140 tons in October alone. That's up 38% year over year. Indian households, which collectively hold more gold than any central bank on earth, are accelerating their purchases. Why? Because they've seen this movie before. They watched their currency devalue in the 1990s. They watched the rupee collapse in 2013. They know that when governments print money, gold protects purchasing power. It's generational knowledge passed down through families. Now let's talk about central banks, because this is where the signal gets really loud. In the third quarter of 2024, central banks bought 337 tons of gold. That's the highest quarterly purchase in over a year. But here's the kicker. It's not the usual suspects. Yes, China bought 23 tons. Yes, India added 27 tons. But look at Poland. Poland bought 42 tons in 1 quarter. Turkey bought 39 tons. These aren't the world's largest economies. These are countries that are actively de-dollarizing, actively moving away from dollar dependence, and they're using gold as their bridge currency. Why would Poland, a NATO member, a European Union country, be buying gold at the fastest pace in their modern history? Because they're watching what happened to Russia. When the West froze $300 billion of Russian foreign exchange reserves in 2022, every central bank on earth learned a lesson. Dollar reserves can be weaponized. Treasury bonds can be frozen. But gold? Gold sitting in your own vault can't be sanctioned, can't be frozen, can't be confiscated with a keystroke. Poland is buying gold because they're buying sovereignty. And here's something most people missed. In September, the BRICS summit announced they're working on a new settlement currency. Not a BRICS currency exactly, but a settlement mechanism backed by a basket of commodities, with gold as the anchor. Now you might think, yeah, they've been talking about that for years. True. But this time, they announced the infrastructure is being built. The mBridge platform, a blockchain-based settlement system connecting central banks in China, Thailand, UAE, and Saudi Arabia, just completed its first live transactions. Real money, real settlements, bypassing SWIFT, bypassing the dollar. What does this have to do with gold stackers? Everything. Because when the world's reserve currency starts losing its monopoly on international trade, when countries can settle in alternative mechanisms, the demand for dollars drops. And when demand for dollars drops, the Fed has two choices: let the dollar collapse, or print more dollars to buy them back and support the price. Either way, gold wins. Dollar collapse, gold soars. Money printing to support the dollar, gold soars. It's a win-win scenario for physical holders. Let me tell you a story about 1971. Most people know that's when Nixon closed the gold window, ending dollar convertibility to gold. But here's what they don't teach you. In the 2 years before Nixon's announcement, foreign central banks were already draining Fort Knox. France sent a battleship to New York Harbor to pick up their gold. Germany was demanding physical delivery. The Swiss were converting dollars as fast as they could. The smart money knew the system was breaking before the official announcement, and those who positioned in gold before August 1971 watched their purchasing power multiply by 10 over the next decade. We're in a similar setup right now. The official narrative is that everything is fine. The dollar is strong. The Fed has everything under control. But look at what the smart money is doing. Look at what central banks are doing. Look at what the COMEX warehouses are showing. The signal is flashing red for the dollar and green for gold, and the stackers who've been waiting patiently are now moving from accumulation to acceleration mode. Here's another piece of the puzzle most people are ignoring: the mining supply situation. Gold mine production peaked in 2018 at about 3,300 tons per year. Since then, it's been flat to declining. Why? Because the easy gold has been mined. The ore grades are declining. It takes longer to permit new mines. It costs more to extract each ounce. Meanwhile, demand is accelerating. You've got central banks buying 1,000 tons a year. You've got Asian households buying another 2,000 tons. You've got ETFs, when they're in accumulation mode, buying hundreds of tons. And you've got industrial demand from electronics and technology that's growing every year. Do the math. Annual mine supply is about 3,300 tons. Annual demand is pushing 4,500 tons. Where does the difference come from? Recycling and existing stockpiles. But here's the problem. When the price rises, people hold their gold tighter. Recycling drops. The supply deficit gets worse. It's a self-reinforcing cycle. Higher prices lead to less supply, which leads to higher prices. Now, I want to address something important here because it's relevant to a lot of people watching this. If you're sitting on retirement accounts, 401s, IRAs, and you're watching this gold situation develop, you might be wondering how to get exposure without just buying mining stocks or ETFs. I put together a free guide on how gold IRAs actually work, how you can move existing retirement funds into physical gold without tax penalties, and what the process looks like. It's in the description below. If you've got $100,000 or more in retirement accounts and you're thinking about diversification into physical metals, it's worth checking out. No pressure, just information, if it's relevant to your situation. All right, back to the signal. Let's talk about what's happening in the derivatives market because this is where things get really spicy. The Commitment of Traders report, which shows positioning of commercial banks versus speculators, just showed something fascinating. Commercial banks, the big players like JP Morgan, HSBC, Goldman Sachs, they've reduced their short positions in gold to the lowest level in 3 years. These are the banks that traditionally short gold to hedge their physical positions and to profit from price declines. They're covering those shorts. They're going neutral to long. That's a massive signal. Why would banks who make money shorting gold suddenly stop shorting? Because they see the same supply deficit we're talking about. They see the same central bank demand. They see the same geopolitical shift. And they don't want to be caught short when the squeeze happens. Remember 2020? When gold went from 1,500 to 2,070 in just a few months? The banks that were heavily short got destroyed. They're not making that mistake again. And speaking of squeezes, let's talk about silver for a second because silver is sending an even louder signal. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently sitting at 84 to 1. Historically, that ratio averages around 60 to 1. When gold moves, silver typically moves harder and faster. It's more volatile, more industrial, more sensitive to supply constraints. And right now, silver has its own supply crisis brewing. Solar panel demand is consuming 20% of annual silver production. Electric vehicles use twice as much silver as traditional cars. And unlike gold, silver gets consumed. It's used in industrial applications and not recovered. So when gold stackers talk about getting the signal, many of them are also looking at silver as the leveraged play on the same thesis. If gold goes up 50%, history suggests silver could go up 100% or more. It's riskier, more volatile, but the upside potential is enormous. Now let's zoom out and talk about the macro picture, because this is what ties everything together. We're living through the largest monetary experiment in human history. Since 2020, global central banks have printed more money than in the previous century combined. The M2 money supply in the United States increased by 40% in just 2 years. 40%. That's not inflation, that's currency debasement. And the effects are showing up everywhere. Housing prices up 40%, stock prices up 60%, 30%. Everything priced in dollars is going up because the dollar itself is worth less. But here's the thing. The official inflation numbers say inflation is only 3%. How is that possible? Because they changed how they measure it. They hedonically adjust for quality improvements. They substitute cheaper goods when expensive ones rise. They exclude food and energy from core inflation. It's statistical manipulation designed to hide the truth. But gold doesn't lie. Gold is up 35% in the last 18 months. That's the real inflation rate showing up in the one asset they can't manipulate. And this is why stackers have been waiting. They knew the money printing would eventually show up in prices. They knew the Fed would eventually have to choose between fighting inflation and supporting the economy. And now we're watching that choice play out in real time. The Fed paused rate hikes. They're talking about cuts in 2025. Why? Because the economy is cracking. Commercial real estate is imploding. Regional banks are struggling. The government is paying over $1 trillion a year just in interest on the national debt. They can't afford high rates. They have to cut. And when they cut, when they restart the money printer, gold is going to do what it always does: protect purchasing power. Let me give you a specific example of how this plays out. In 2008, during the financial crisis, gold was trading around $800 an ounce. The Fed dropped rates to 0 and launched QE1, QE2, QE3. By 2011, gold hit $1,900. That's a 137% gain in 3 years. But here's what's different this time. In 2008, central banks were net sellers of gold. They were dumping gold to raise cash. Today, they're net buyers to the tune of 1,000 tons a year. In 2008, China held 600 tons of gold in reserves. Today, they hold over 2,200 tons officially, and probably much more unofficially. In 2008, the BRICS were just an acronym. Today, they're a functioning economic bloc with their own development bank and settlement systems. The setup today is exponentially more bullish for gold than 2008, and the stackers who've been accumulating since 2022, buying every dip, dollar cost averaging through the consolidation, they're the ones who are going to benefit when this thing really moves. But here's what separates the winners from the losers in this trade: understanding the difference between paper gold and physical gold. When I say gold is going higher, I'm talking about physical gold, the stuff you can hold in your hand, the coins, the bars, the bullion. Paper gold, the ETFs, the futures contracts, the mining stocks, they're all derivatives of the real thing. And in a real crisis, in a real squeeze, paper gold can be settled in cash. Physical gold can't. Physical gold is the ultimate form of wealth, the ultimate store of value, because it's no one else's liability. Think about that for a second. Every other asset you own is someone else's liability. Your bank account? That's the bank's liability to you. Your stocks? That's the company's liability to shareholders. Your bonds? That's the government's or corporation's liability to bondholders. But gold is just gold. It's not dependent on anyone's promise to pay. It's not subject to counterparty risk. It's pure concentrated wealth that's been recognized as money for 5,000 years. And this is why, when the signal flashed, when the COMEX inventories dropped, when the central banks accelerated their buying, when the Shanghai premiums spiked, the stackers knew it was time. Time to move from patience to action. Time to accelerate their accumulation before the broader market catches on. Because here's the thing about gold. It moves in stages. First, the central banks buy. That's happening now. Then, the institutions buy. We're starting to see that with hedge funds and family offices increasing their allocations. Then, the retail investors buy. That's the final stage, when your neighbor and your coworker and your uncle are all talking about gold at Thanksgiving dinner. And by the time retail shows up, the big gains have already been made. The stackers who bought at $1,900, at $2,000, at $2,200, they're the ones who capture the full move. So what's the play here? What should someone do with this information? Well, that depends on your situation, your risk tolerance, your time horizon. But I'll tell you what the stackers are doing. They're buying physical metal. They're storing it securely. They're not trying to trade it, not trying to time the perfect entry. They're accumulating a position that they plan to hold for years, maybe decades, because they understand that gold isn't an investment. It's insurance. It's protection against monetary chaos, against currency debasement, against the inevitable consequences of printing trillions of dollars out of thin air. And they're not putting everything into gold. They're diversifying. Maybe 10% of their portfolio, maybe 20%, maybe more, depending on their conviction. But they're treating it as a core holding, not a speculation. They're buying on dips, holding through volatility, and ignoring the noise from mainstream financial media that constantly tells them gold is a barbarous relic. You know what's funny? The same people who call gold a barbarous relic are the ones who panic buy it when crisis hits. In March 2020, when COVID lockdown started, gold dealers were sold out for weeks. Premiums spiked to 20% over spot. You couldn't find an American Eagle or a Canadian Maple Leaf anywhere. The people who waited until crisis to buy paid massive premiums and had to wait months for delivery. The stackers who bought before the crisis, they just sat back and watched their wealth preservation strategy work exactly as designed. That's the lesson here. The signal isn't about getting rich quick. It's about recognizing when the conditions are aligning for a major move and positioning before the crowd figures it out. It's about understanding that we're in the early stages of a monetary reset, a shift away from dollar dominance, a return to hard assets and real money. And gold, physical gold, is the ultimate expression of that shift. The stackers got their signal. The question is, are you paying attention? Because this opportunity won't last forever. Once the mainstream catches on, once the ETFs start seeing massive inflows, once gold breaks $3,000 and holds it, the easy money will be gone. The time to position is now, while central banks are still accumulating, while COMEX inventories are still draining, while the Shanghai premiums are still elevated. The time to act is before the crisis, not during it. And remember, this isn't about predicting the future. It's about preparing for multiple possible futures. Maybe the Fed successfully engineers a soft landing and inflation stays contained. In that scenario, gold probably consolidates and grinds higher slowly. Maybe the Fed cuts too soon and inflation reignites. In that scenario, gold explodes higher. Maybe we get a deflationary crash and the Fed responds with massive stimulus. In that scenario, gold initially dips, then rockets higher. In almost every scenario, gold preserves wealth better than cash sitting in a bank account losing purchasing power to inflation. The stackers understand this. They've done their homework. They've studied monetary history. They've watched what happened in Weimar Germany, in Zimbabwe, in Venezuela, in Argentina. They've seen how quickly currencies can lose value when governments lose fiscal discipline, and they've decided that holding a portion of their wealth in the one asset that survived every currency collapse in history is a smart, prudent move. So that's the signal. That's what the stackers have been waiting for. The convergence of supply deficits, central bank buying, geopolitical shifts, and monetary policy that all point in the same direction. Higher gold prices ahead. Not in a straight line, not without volatility, but higher over time as the dollar's purchasing power continues to erode and the world continues to diversify away from dollar dependence. The choice is yours. You can ignore the signal and hope that the current monetary system continues indefinitely. Or you can take a page from the stacker's playbook and position a portion of your wealth in the one asset that's protected purchasing power for thousands of years. Either way, the signal has been sent, the stackers are moving, and the next chapter in gold's bull market is just beginning.